is a senior member. Is taking care of the Tirupur branch for the past more than 2 to 3 decades.
Oh, great, sir. Welcome, sir.
Sir, welcome, sir. Sorry, sir. Now we are able to see me.
No, sir.
No,
not
sir.
yet.
1 minute. We'll see that. Now, if you are able to see me.
இல்ல சார்
Sorry, sir. No, sir.
சார் வெளிச்சம் வந்துருது உங்க வெளிச்சம் நீங்க
Video on ஆயிடுது பட்
ஏதாவது தெரியுதா?
இல்ல சார், இல்ல
சார்.
இல்ல சார்.
இப்போ நீங்க ஸ்டார்ட்
பண்ணிடலாமா? Okay, sir. Yes, sir. Good morning to everybody. Welcome you all to the session this morning. This is the final installment in the session conducted by Shri C.A. Vivek Rajan. It's been a very informative set of classes that we've all been privileged to attend, I would say. Handing over the proceedings to Shri M.J.V. sir. Thank you.
Thank you, Deeparao.
Yes, sir.
On behalf of Direct Tax Committee of the Chengalpattu branch of SARC of ICAI, I welcome you all. In fact, as Deeparao said, it's a last installment. In fact, like advanced tax, the last installment, she said. So anyhow, to fulfill all the amendments to be covered, we are going to have we propose to have a second series of this session, probably in the end of the April and first week of May. We are planning with the same eminent speaker Vivek Rajan. Of course, those who have attended, they know about him. Even for the newcomers also of this session, I would like to introduce Vivek Rajan is a fellow chartered accountant in practice based out of Chennai. He has more than 12 years of experience in the profession, and he has written many articles on legal matters. One of his articles on audit report under the Companies Act published in September 2014 and has been read and shared by many readers and has generated 71,000 views at February 22. And he has been regular contributor to the articles published in the monthly bulletins of Chartered Accountant Study Circle, which is one of the oldest study circle in the city. His discussion paper on the union budget 16, 17, 18, 19 has been well received and published. And he has got the best article award for both the years 2018 and 19. His discussion paper for the Finance Act 2019 in CASC, that is Chartered Accountant Study Circle, was a 7-part monthly series that covered 100% of the amendments on direct taxation in a detailed manner. So Vivek Rajan is also one of the faculties of the Indirect Taxes Committee of the ICAI for GST. So now, with regard to this session, as he has covered all the 4 sessions, first, initially we will have a recap of all the 4 sessions. And then we will go into the 5th session, which is the end of the first series. And members, before I forget, with regard to this, actually, you are all aware that CBDT is going to notify the new form 3CA, 3CD, and 3CB for the assessment year 22-23, for which our Direct Tax Committee of ICAI has requested all the members to share the valuable suggestions and amendments, for which we have sent on behalf of Chengalpattu branch Direct Tax Committee. We have just shared the Google form in both WhatsApp and as well as in mail. So kindly give your valuable suggestions and amendments, whatever, and to ease out the filling up of the form on or before 14th of March, so that we need to share it with the Direct Tax Committee of ICAI before 15th. So kindly go through that provisions and kindly give your valuable suggestions. Now over to Speaker Vivek Rajan. Thank you.
Sir, 1 second, sir. So it's a series of sessions for the past 4 series is over. This is the 5th session for Vivek Rajan. I request those who are attended all the 4 series, I requested the members to just give a word on how the past 4 meetings and what you expect more from the branch and from the speakers. I request Mr. Saravana Bhavan sir, because sir, Saravana Bhavan sir. Because it's a very good feedback from all the members, the part of the sessions. So sure, we will continue in the month of fag end of April and May, the remaining other things. If anyone interested to give your feedback, either in the session or by mail, please forward to our mail ID or come forward. Thank you. Over to you, Rajan sir.
Okay, sir.
Thank you.
Very good. Thank you, MJB sir. Thank you, Narayan sir. Thank you, everybody. Very good morning. Welcome to one and all. Thank you to each and every one of you for making this special one. Very happy to present here, and it's been a wonderful set of 3 weeks preparation mode and referencing and everything. So I would like to thank everyone in Tamil. ரொம்ப ரொம்ப நன்றி. ஏன்னா இந்த 3 hour வந்து ரொம்ப என்ஜாயபிளா இருந்தது. ஏன்னா ரீடிங் எவ்ரிதிங் ஃப்ரம் த பேஸ் அண்ட் செக்கிங் எவ்ரி அமெண்ட்மெண்ட் அண்ட் உங்க மெட்டீரியல் ஃபார் சர்க்குலேஷன் அம்சத்துக்கு அதுக்கப்புறமும் there will be some amendments where we will have to incorporate at the last minute stages. வேற ஏதாவது படிச்சிட்டு இருக்கும்போது. So overall, thanks to each and every one of you for the opportunity given and wonderful presenting here. I'll start with the recap of the first 4 sessions that has taken place. The first session took place on 25th February 2022. The amendment that we discussed again largely with respect to cryptocurrencies. One small amendment with respect to slump sale. Slump sale is more of a clarificatory amendment that includes every form of transfer in the scope. So there is no more the concept of only sale being subjected to tax under slump sale. So any other form of transfer has been included in the scope of slump sale. So this is a more of a clarificatory amendment. The next of the amendments we discussed was amendments with respect to taxation of virtual digital assets, popularly known as cryptos, non-fungible tokens. So as everyone could appreciate, there are plenty of things that is coming around crypto daily. We'll have so many online platforms giving advertisements. Either when we open the smartphone, a YouTube ad, we'll see a cryptocurrency advertisement, or in a national newspaper front page opportunities for investing in crypto. So the cryptocurrency as such, it is so evolving. The government has chosen to open the innings, I would say, with respect to cryptocurrency by first introducing the taxing provisions. So first, Indian government has started to tax the crypto provisions. I'm sure in the budget to follow in the subsequent year, there will be many amendments with respect to cryptocurrency, and there will be other aspects with respect to cryptocurrency, because I believe it is time for the government to give a white paper on cryptocurrency, because taxing it is one part of the system in my view. But the procedural aspects and all the other aspects with respect to other acts like FEMA, then somewhere SEBI also might come into the picture. So all these other aspects, I'm sure it's time that, in my view, a white paper from the government, it would give very much a clarity on what is the cryptocurrency at present it is there, and it will also help in regulating the cryptocurrency to such an extent so that it is better for every player in the cryptocurrency, because online platforms is there. Online platforms are being run by some Indian companies. Online platforms are being run by foreign companies. Taxation aspect is there in both. GST aspect is there, and the online platform will connect with another online platform. So many opportunities, many intricacies involved in this crypto. So in the days to come, with the government giving more clarifications and more circulars and probably a research paper or white paper on this kind, will definitely throw more light, and we will be having much more information about crypto. So stepping into the crypto, the government has defined the virtual digital asset. Virtual digital asset is any information code or number or any token or any other item by whatever name called. What virtual digital asset should do? It should provide a digital representation of value exchanged with or without consideration. It should have the promise or representation of having inherent value. It should function as a store of value. A unit should be a unit of amount, including its use in any financial transaction or investment. It should not be limited to investment scheme. It can be transferred, stored, or traded electronically. It should be a non-fungible token or any other token by similar nature, by whatever name called. It can be any other digital asset that the central government may specify. Though the government has defined virtual digital assets, the terminologies under virtual digital assets has not been defined by the Act. For example, what is a store of value? It's an asset that maintains its value rather than depreciating. Non-fungible token, it's a cryptographic asset on a blockchain with unique identification code. Blockchain, it is a general ledger that is available on the internet with information as to who is the seller, who is the purchaser, what is the product that is being purchased. Again, still from Indian perspective, this is largely unregulated. It is happening on the internet with crisscrossing all the tax boundaries with servers located in some part of the country. So largely this is being unregulated. And if you could see any online platform that is giving an advertisement, when it is giving an advertisement for asking people to invest in crypto, there is a small description, star mark description that is generally that we can associate with mutual fund investments. Of course, mutual funds investments are regulated, but with respect to crypto, it is sort of a disclaimer stating that you invest money in crypto to the extent that even if you are going to lose the money in crypto, you are not badly hit by this, because the way in which cryptocurrency investments are propping up with the space at which these are going up. I foresee many college students, people who are just starting to earn, they'll be more attracted with these cryptos, and they will be wanting to invest in cryptos, because today we see a circumstance whereby college students, they can get credit card without having any income. Actually, there are companies which are giving credit card to college students, just like how they give credit card to based on salary or some other perspective. So when this is coming to them, cryptos are also coming. So younger generation people might tend to be attracted towards investing in cryptos. So that is how it is developing. NFTs is one particular model in that. NFTs, as I remember recalling that NFTs are like, it is an intangible asset. So it applies to any intangible item that you might have, whether an intellectual property right that you have, or whether you have a painting, or whether you have anything. So anything that is subject to, that can be used as NFT, and that can be traded in the crypto market. So what is taxable? Section 115 GBH was introduced with effect from 1st April 2023. Tax is at 30% of the income. Income is sale proceeds minus cost of acquisition. No other deduction being allowed. No carry forward of loss was being allowed. Practical illustrations, we saw that only the cost is allowed as a deduction. Loss is not allowed as a deduction. We also saw a scenario whereby how the provisions of section 194S prevails over 194O. Both talks about deduction of TDS with respect to crypto. Again, deduction of the TDS with respect to crypto, it is compliant. This is a very challenging aspect in terms of compliance, because practically speaking, the online platforms discharge the money. So they will have to deduct TDS on every transaction, and that has to be properly reported. And to that extent, 26 years, it will get updated. To that extent, certificate has to be issued. Any errors in that, it has to be rectified, and all these things happening. And at the cost of repetition, I foresee so many individuals who are trading in shares. They will also be starting to trading in. Most of them would be starting to trade in cryptocurrency. And yesterday, I remember giving an example of how the NFTs are evolving. NFTs are evolving in the entertainment sector. I gave an example of how the movies scenes are being sold as NFTs. As part of new example, I know recapping this on a daily basis, most of you would have seen it on the earlier sessions. So I wanted to give an additional flavor of an example. So one other example that I could find out today is, most of us could see the gaming industry is evolving very much. And ever since the first lockdown, there is one particular report which says that the gaming industry has developed a multiple number of times in the first lockdown, second lockdown, largely due to the younger generation playing more games in the mobile. Because during the lockdown, most popular game being PUBG game, with many youngsters would play. So that gaming sector already is getting very much impetus. Now cryptocurrency has ventured into the gaming sector too. In fact, there are games. NFT concept has come into the gaming sector. And there are games like play to earn blockchain games. So that is how the cryptos are getting into the gaming sector also. So as we speak, every day there is an evolvement with respect to crypto. So I think it may not be out of context to to just submit my view in this regard, that in my view, we should have an exclusive session on how this cryptocurrency's impact is there on all the industry is concerned. Because at best, we have information as to what is going to be taxed, what is the TDS in this regard. But the players in this crypto are so many. For example, an individual who is investing in an online platform, which is receiving the investment, which is facilitating the trade, who is holding the online platform, whether an Indian company or a foreign company, and how this technology is being transferred. And in my view, this is an opportunity that many software companies would avail. For example, blockchain technologies, there are 100 more companies in the blockchain technology concepts in India at present. And in my view, all the software companies in India at present, those whose business relate to development of apps, probably they will be having lot many opportunities in crypto. How they will be having lot many opportunities because of crypto is that they will be either directly or indirectly rendering some service with respect to the cryptocurrency players. For example, an online platform is there. For the blockchain coding, they will be engaging some services of some software companies. So some of the software companies may do a back-end process for this crypto companies which facilitate the crypto trade. So when you see the players as such, not only from the individual who is investing or the entity that is investing and the government that is taxing, there are so many players being the online platform, people servicing the online, people rendering service to that online platform, and the TDS aspect is there, income tax aspect is there, GST aspect is there, and somewhere FEMA also comes into the picture. So I feel an exclusive session might be required to analyze the aspect of crypto on all the players, TDA, income tax, GST, and then eventually FEMA, so that everyone can be well appreciated of what is going to happen in the times to come. So this is Rajan with respect to cryptocurrency. Gifting of cryptocurrency is also taxable as per section 56(2). This was the first session. Now I'm going to give a recap of what we discussed in the second session. And at this situation, I would like to mention that after the finance bill has been presented by the Honorable Finance Minister, our institute, as well as the Honorable Bombay Chartered Accountant Society, as well as our Honorable Institute, they both have made representations to the central government, citing some provisions and requesting the government to reconsider the same about this provisions being it can give some hardship to the taxpayers. So please reconsider the same. The representations have been given. On the second day, we largely discussed about amendments relating to Section 10. Section 10, it was split into amendments relating to gift IFSC and amendments relating to 1023C. Gift IFSC, just 1 minute into recap of gift IFSC. International Financial Services Center. At present, India's first International Financial Services Center is located in the state of Gujarat. It is called as Gujarat Gift City. So the incentives that is available for the units in IFSC are many, major of them being 100% tax exempt for 10 consecutive years, and some state GST is also not applicable. For the investors in IFSC, the interest income that is paid to a non-resident, received by a non-resident for investment in the gift IFSC units is also not taxable. At some stages, the capital gain arising on transfer of the securities also not taxable. The explanatory memorandum categorically acknowledges that need to incentivize operations from IFSC is there, because IFSC from 2016, ever since it came into the Income Tax Act, every year there has been a positive amendment to the IFSC from 2016 all up to 2022, and the trend continues. So what is the amendments with respect to gift IFSC that we saw is that the exemption, already an exemption was available for trading with respect to non-deliverable forward contracts. Now there is an exemption under 10 section 4E for income accrued from transfer of offshore derivative instruments. So what is offshore derivative instruments? It is more of a promissory notes that is prevalent. Present promissory notes are under the regulation of SEBI. Whether this offshore derivative instruments also, whether it would come part of SEBI, well, it is a question that we'll have to wait and see. One view is that if its state comes into the IFSC purview, then SEBI's purview will not be there. That is one view, but we'll have to wait and see as to what is the final what is the involvements in the subsequent stage. And the income from transfer of over-the-counter derivatives, that exemption is also given to participants in terms of as part of subsection 4E. What is over-the-counter derivatives? It is the futures, swaps that we generally associate with the share transactions. So that is a benefit that they have given. In addition to this benefit, as part of current days discussion, there is one another section that is given benefit to the gift IFSC, about which we'll be seeing as part of current today's content. Then amendment of section 10(4)(e), the interest income from leasing of aircraft or ship. Already, interest income from leasing of aircrafts to the non-resident players is exempt from tax, subject to the conditions prescribed. One of the conditions being the operation should have started on or before 31st of March 2024. So we saw that there were many airline companies that are invested in the GIFT IFSC. They got approval to start from the start their operations based out of GIFT IFSC. I also remember saying example about an Ireland company investing in Ireland Aerospace Company investing in GIFT IFSC in Chennai. Ireland are considered to be the world leaders with respect to project financing of aircraft, because the leased aircraft comes at a lower cost rather than purchasing an aircraft which involves huge outflow. So we saw that interest on account of that is exempt from tax. Just like how the benefit has been given to the airline industry, the same benefit has been extended to the shipping industry. So with the amendment of Finance Act 2022, income of non-resident by way of royalty or interest on account of lease of a ship paid by a unit of an IFSC under 80A only is exempt from tax, provided the operations are commenced before 31st of March 2024. And exemption from income received from portfolio of securities is also given to the GIFT IFSC. So this is the amendment with respect to GIFT IFSC we saw. The next cluster of amendments we saw with respect to 10 subsection 8, 8A, 8B, 8, 10, 9. One line summary of that is that at present scenario, up to Finance Act 2021, diplomats involved in service of foreign countries in India, they will be assigned duties in India subject to an agreement with the foreign country. They can be either a consultant, they can be either an individual who is representing, or they can be a consultant. So the individual would be receiving an income, the consultant would be receiving an income. The residential status of a consultant can be a foreign citizen or a not ordinary resident in India. So all this, and the employees of that consultant, they would also receive such remuneration. And the family members of the consultant or individual, they would also receive such remuneration. All such remuneration was exempt from tax till Finance Act 2021, up to Finance Act 2021. With the Finance Bill 2022 proposes to stop this, and by phasing out it intends to phase out this exemption, stating that all these things it's a thing of the past. It has outlived the era. In the matter of simplification of tax laws, these exemptions are phased out. The next of the amendments that we saw on the day 2 was amendment with respect to 1023C4, 5, 6, and 6A. Last week we saw this. Quite exhaustive amendments that has far-reaching implications, and specific to this only our Honorable Institute and our Bombay Chartered Accountants Society both have made representations to the government about this. So what are the amendments with respect to the trust? One particular amendment was that the prescribed authority, the regulations with respect to the trust has gone a dynamic change in the past little over 2.5 years, 3 years. So in most cases, the prescribed authorities were the principal commissioner or the commissioner. In certain cases, the prescribed authority was not fixed. So Finance Bill 2022 fixes that prescribed authority to be the principal commissioner or commissioner at the places of section 1023C4, 5, 6, and 6A. The next of the amendment is what is the tax implication in case of voluntary contribution received for renovation and repairs of temples, mosques, gurudwaras, churches, and other places of worship under ATG. So the explanatory memorandum says that in this particular scenario, donations are received for repair of temples, mosques, and gurudwaras and other places of worship. However, it is not clear that such donations are treated as corpus donations or whether it can be applied or accumulated for a period of 5 years. This amendment to propose to give clarity. So what is the amendment? Where the trust or institution receive donation of such kind, it may be treated by such trust or institution as forming part of the corpus of that trust or institution. The above is subject to the following conditions: that trust or institution applies such corpus only for the purpose for which the contribution was made. Trust or institution does not apply such corpus for making contribution or donation to any other person. Trust or institution maintains such corpus as separately identifiable. And trust or institution invests or deposits such corpus in the form and mode specified under 11.5. Further, if any trust or institution has treated any sum received by it as forming part of corpus and subsequently violates any of the conditions specified above, such sum shall be deemed to be the income of the trust or institution of the previous year during which the violation took place. The next of the amendment was amendment to 1023C, bringing consistency in the accumulation provisions. So what is the accumulative provisions that we saw? It was a 4-part explanation, explanation 3, explanation 4, explanation 5. Explanation 3, under the existing provisions of the Act, a trust or institution is required to apply 85% of the income for a period of over 5 years. That is subject to fulfillment of conditions specified in 11 and all the conditions. However, there are no such provisions under the 1023C. These provisions are there under 11, the trust ratio under section 11 and 12, but no such provisions are there for trust or institutions or hospitals registered under 1023C. The explanation is added to give effect to that. And explanation 4 is continuation of explanation 3, and explanation 5 is a continuation of explanation 4 and 3. So what we saw in explanation 3, if 85% of the income is not applied wholly and exclusively by the fund or trust or institution, that need not be subjected to tax. It can be accumulated subject to the following conditions: that such fund or trust or institution furnishes a statement to the AO stating the purpose of accumulation, purpose of setting apart, and the period of accumulation and the period of setting apart under 139(1). The period of accumulation should not at any case exceed 5 years. The money so accumulated or set apart is invested or deposited under the provisions of 11 subsection 5, that includes post office and any of the specified securities mentioned by the central government. The period during which the income could not be applied owing to an order or injunction of a court shall stand excluded. Explanation 4. Explanation 3 gives a conditional exemption, I would say, that if you are not investing your 100%, 85%, then subject to the conditions specified, you are given an exemption, to put it in simple terms. Explanation 4. Explanation 4 talks about that if the conditions are not met, if the conditions specified under explanation 3 is not met, then how it is going to be taxed, in which year it is going to be taxed. The explanation 4a talks about a situation where the income referred to in explanation 3 is applied for purposes other than wholly or exclusively to the objects of the fund, trust or institution referred to under 1023C4, 1023C5, 1023C6 and 1023C6A. It shall be deemed to be the income of such person for which the previous year in which the non-compliance occurs. Then 4b talks about a scenario whereby any income referred to in explanation 3 ceases to remain invested or deposited in any other form or mode specified under 11.5. Explanation 4c talks about a scenario where it is not utilized for the purpose for which it was so accumulated. Then it will be taxable in the year, it shall be deemed to be taxable in the year in which the income of such person for the previous year being the last previous year for which income is set apart, accumulated but not utilized for the said purposes. Then explanation 4d, the crucial section, it says that if the income referred to in explanation 3, if it is credited or paid to any trust or institution or to any other educational institution or hospital, then it shall be deemed to be the income of such person in the previous year in which it is paid, credited or to any fund, institution or hospital or medical institution. So explanation 4, to put it in simple words, talks about scenario where a conditional exemption given in explanation 3, if the condition is not followed, it will be taxable. And explanation 4 talks about when that will be taxable. We also saw an example for each of the clauses that I will summarize subsequently. Explanation 5, it again gives an exclusion to explanation 4. It says that explanation 4 will not be applicable if there are circumstances that is beyond the control of a trust. So what are the circumstances that is beyond the control of the trust, that we will see in that example. So if there is a situation that is beyond the control of the trust, the concerned trust should make an application to the AO mentioning about that particular condition, and if the assessing officer is satisfied, then the provisions of explanation 4 would not apply. In other words, the income that is not spent, income that is not accumulated would not be subject to tax, subject to what is the declaration that we are giving in explanation 5, and subject to the following of the conditions specified in declaration filed under explanation 5. This was the amendment with respect to 1023C, explanation 3, 4 and 5. The last of the amendments that we saw was books of accounts to be maintained by the trust or institution under both regimes. The 10th proviso was replaced. So far, the 10th proviso talked about only the audit requirements. The trust has to get its accounts audited by an accountant specified under 288. Now that requirement it is there. Plus, the income tax will specify what are all the books to be maintained by the trust, and what is the location at which the books should be maintained. The books of accounts should be maintained. Other documents to be maintained in such form and manner and at such place as may be prescribed. So we will have to wait and see as to what is the books of accounts that the central government specifies, what is the other form and manner it specifies, and most importantly, what is the place that may be prescribed. Because a trust has many of us to understand, it can operate in more than one place. Some trusts have pan-India presence, so where the books of accounts has to be kept. So this is what we discussed in session 2. Towards the end of session 2, we had an idea as to discussing about explanation 3, 4 and 5 with examples on the next session. So accordingly, on the next session, that is on last Saturday, we had practical illustrations on explanation 3, 4 and 5. Example, I would like to recapitulate again. A trust covered under 1023C, whose main objectives are providing free education and plantation of trees for upliftment of environment, it received a sum of 50 lakhs for plantation of tree samplings in September 2022. But according to its estimate, the plantation activity could extend up to March 2025, and it could not be completed by March 2023, with only 5 lakhs getting applied up to March 2023, 25 lakhs getting applied in financial year 23-24, and 20 lakhs getting applied in financial year 24-25. So we will see the implications on a year wise. Financial year 22-23, the trust had to furnish a statement to the AO stating the following: the purpose of accumulation is extension plantation activity and follow up thereof. The amount of accumulation is 45 lakhs. The period of accumulation is 12 months. Unspent amount invested in the post office savings bank is 45 lakhs. Amount taxable for this year is nil. So this particular example pertains to explanation 3 that we saw here. So this is the conditions that the trust has to follow, and this is the example. This particular example relates to the conditions. So financial year 23-24, trust has to furnish an updated statement, pretty much the same particulars with the updation stating that this particular amount has applied during the year and only a balance is accumulated for the next 1 year. Let us come to financial year 24-25. What happens? Explanation 4A. Explanation 4A talks about scenario where the income referred to in explanation 3 is applied for purposes other than wholly and exclusively for the objects of the trust. So in explanation 4A, under the example, the trust fails to apply the funds for specified purpose and spends the same on administrative purpose and transfers the money to person specified under section 13. Person specified under section 13 sometimes includes the managing trustees of the concern or relatives of the trustees. So in that scenario, the amount taxable in financial year 24-25 is 20 lakhs. That is the balance amount that was not spent. Explanation 4B. The trust withdraws money from post office savings bank, one of the prescribed modes of investment under section 11, and it retains for financial year 24-25. So the amount taxable in financial year 24-25 would be 20 lakhs. The next explanation 4C, whereby the trust spends only 15 lakhs in financial year 24-25 and the balance 5 lakhs remains to be applied. The amount taxable for financial year 24-25 is rupees 5 lakhs as 15 lakhs has been applied. The last of the example, explanation 4D, where the income referred to in explanation 3 is credited or paid to a trust or institution under 12AA or 12AB or to any other fund or trust or institution, it is taxable. So in this scenario, the trust donates a sum of 5 lakhs to another hospital for treatment of cancer for a particular patient. This can be a genuine purpose donation, but a literal interpretation of explanation 4D says that if a trust transfers a sum of rupees 5 lakhs to another hospital, then in that case, that would be taxable because of the explanation 4D. Then we saw an example for explanation 5, whereby due to financial year 24-25, for an example purpose, let's assume there is a pandemic and there is a consequential lockdown, and the trust could not apply the balance of 20 lakhs. The trust makes an application to the AO stating the pandemic and further mentions that it would spend the balance amount on education of children rather than planting of trees. Why that particular stand was taken by the trust? Because education of children means online education. So we'll have to spend on the online education. Planting of trees, it requires physical visit to the concerned place. With the lockdown, the physical visit could not take place. So that is why the trust chooses to spend the balance on education of children. However, later stage, the trust there is a scenario that develops whereby due to the said pandemic, people are getting affected, and the trust plans to donate 5 lakhs to the people affected by the pandemic. It plans to donate 5 lakhs to the trust, to another trust for medical expenses for the people affected by the pandemic. In this case, according to explanation 4D, the amount of rupees 5 lakhs is taxable. This is what we saw. Then what we saw with respect to one another amendment of 1023C is that the 15th proviso has been completely replaced. The 15th proviso largely dealt with registration or approval, cancellation of approval for non-genuine trust and the procedures aspect with respect to that. Including the aspects that the timeline was not prescribed within which the principal commissioner or a commissioner has to pass an order for cancellation. All this was there as part of the existing mechanism. So by replacing the concerned proviso, all these aspects has been addressed. So how this is being addressed? The present situation where we saw in fund and institution referred to 1023C4, 5, 6, 6A, it is notified by the central government. If it is not applied any income or invested the balance in accordance with the proviso, whether the activities carried by it are not genuine, or if the such entity has not complied with the requirement of any other law, then after giving an opportunity of reasonably being heard, the commissioner or the principal commissioner may cancel the registration of the trust and forward a copy thereof. This is the existing scenario. What is the amended scenario? Amended and substituted clause. The principal commissioner and commissioner are the authorities in this regard. That is one of the amended and updated scenario. The principal commissioner or commissioner notices one or more specified violation. What is a specified violation? We will see subsequently. The principal commissioner or commissioner received a reference from the assessing officer for any of the previous years, or the principal commissioner has received the risk management strategy report formulated by the CBDT. So see, these are the three modes of information through which the principal commissioner or commissioner can receive a report about a particular trust. Once the report is being received by the principal commissioner or commissioner, they will call for all the documents on the concerned trust, has to give all the documents to the best of its ability, and the commissioner after giving the opportunity, the commissioner can pass an order either cancelling the approval of such entity with a specified date, or the commissioner can pass an order refusing to cancel the approval. Both scenarios can happen, subject to the documents provided by the trust and subject to the processing by the commissioner, subject to the legality of the documents specified. So we saw what is the specified date. The specified date means the day on which a period of 6 months calculated from the end of the quarter in which first notice was issued by the PCAT or CAT on or after 1st April 2022, calling for such document or information or making any inquiry under step 2 expires. Example, we saw that the principal commissioner issues notice on 1st May 2022, the quarter ends on 30th June 2022. 6 months from the end of the quarter ends on 31st December 2022. The principal commissioner has 8 months from the date of first notice. We also saw what is a specified violation. Specified violation has been defined in a very, very detailed manner. So broadly, if the fund or trust or institution has been applied, the funds of the trust or institution has been applied other than for the objects of the trust. If it has income from profits and gains of business which is not incidental to its objectives, where separate books of accounts are not maintained by the trust, which is incidental to the attainment of its objectives. We also had an extensive discussion as to when can a business be regarded as not incidental to the objectives, because there are many trusts which carry business which many decisions say that it is incidental to the objectives. So if this condition is not met, that is also a specified violation. Then one of the specified violation is that where the activity of the trust is found to be not genuine or it is not carried out, the activity is not being carried out in accordance with all or any conditions subject was notified, and where the fund or institution has not complied with any other law for the time being in force. I remember giving an example whereby a trust registered under section 1023C or section 11, it had an FCRA registration. If that FCRA registration is cancelled because of non-fulfillment of the conditions specified in the FCRA Act, then that could be also a reason for it to be regarded as a specified violation. We also saw the provisions of that. Explanation 3, where the AO has intimated the central government of executive authority about the contraventions of the same. Such intimation shall be deemed to be an intimation received on 1st April 2022. This I would like to give a recap. In simple words, if an AO has given information to the commissioner and that assessment proceedings has not reached finality until 31st of March 2022, then for all practical purposes, that intimation by the AO to the assessing or to the commissioner shall be treated as shall be deemed to be an application given by the AO on 1st April 2022. So in simple terms, any pending proceedings as on 31st March 2022 with respect to all the scenarios that we discussed, if it has not reached the finality, then it would be deemed as an application or the notice as on 1st April 2022, and the provisions of the amended 15th proviso would apply. This is what we saw as part of the third session. The amendment that we discussed on yesterday, amendments with respect to section 14A. 14A, it is one of the crucial sections that that has been in the Act from Finance Act 2001. With the Finance Act 2001 introduced it from retrospective effect from 1962, I believe. So 14A of the Act provides that no deduction shall be allowed in respect of expenditure incurred by the assessee in relation to income that does not form part of total income as per the provisions of the Act. So over the years, disputes have arisen with respect to the issue whether disallowance under 14A of the Act can be made in cases where no exempt income has accrued, arised, or received by the assessee during the assessment year. The CBDT gave a circular in 2014, circular number 5 of 2014. Yesterday, I shared the circular for everyone, clarifying that Rule 8D read with 14A of the Act provides for disallowance expenditure even when the taxpayer in a particular year has not earned any exempt income. However, still some courts have taken a view that if there is no exempt income during the year, no disallowance under 14A of the Act can be made. So, in simple terms, if there is an expenditure that points towards an exempt income, irrespective of the fact that whether that exempt income is received or not, whether the income is accrued or not, 14A provisions would start to apply. And once 14A starts, as a consequence, Rule 80 would start to apply. We saw the illustration as to how the legislative intent is being displayed here. For a non-exempt income received of 2 lakhs, the expenditure for the non-exempt income is 1,50,000. The expenditure for exempt income is 30,000. The exempt income received during the year is per nil. So, if we are claiming that expenditure for exempt income as an expenditure without giving effect to the provisions of 14A, the profit for the year would be 20,000. If the same is being disallowed under section 14A, the profit for the year would be 50,000. So the explanatory memorandum categorically mentions that by holding that the provisions of section 14A does not apply in case of non-receipt or non-accrual of exempt income during the year, it amounts to allowing rupees 30,000 as expenditure for non-exempt income, even though the said sum was not incurred wholly and exclusively for the purpose of earning non-exempt income. Such an interpretation would defeat the legislative intent of 14A and section 37 of the Act. So, in order to make the legislation intent of the legislation very clear and to make it free from any misrepresentation, 14A has been amended. How 14A has been amended? 2 crucial amendments, simple 2-line amendments, but capable of giving the strong effect to 14A. And these 2 lines give the categorically confirms the view of the central government, stating that notwithstanding anything to the contrary contained in this Act. So 14A prior to this amendment did not have this non-obstant clause. So with this amendment is as a non-obstant clause, stating that notwithstanding anything contrary contained to this Act, so the provisions of 14A would apply. The non-obstant clause has been given. Then an explanation has been inserted, stating that for the removal of doubts, it is clarified that notwithstanding anything to the contrary contained in this Act. So the section has a non-obstant clause to start off with, and the explanation making it double clear, stating that it is also having a non-obstant clause. So the intention of the lawmakers is being clearly mentioned that the provisions of this section shall apply and shall be deemed to have always applied in a case where the income not forming part of total income under this Act has not accrued or arisen or has not received during the previous year relevant to the previous year in which expenditure has been so incurred. So, in simple words, we cannot take a stand that we have not received any exempt income has not arisen or has not accrued. Irrespective of all the scenarios, if any expenditure incurred, if it points to an exempt income in the future, then disallowance under 14A has to apply. So, while finalizing the audits, we will have to specifically see whether any expenditure incurred, whether it has a possible linkage with an exempt income that can be received in the future. What can be exempt income? Exempt income law has to specifically mention that this is an exempt income, or certain incomes can be in the nature of capital receipt. The revenue might contend to be revenue receipt. So sometimes capital receipt will not be subjected to tax. So we will have to see as to what are all the expenditure, what is the income earning connection with, what is the income that is arising out of that expenditure, and if that income is not taxable, then to that extent the provisions of 14A would apply. In yesterday's material, I also referred some of the cases that have been overruled by virtue of this amendment. The next of the amendment that we saw yesterday was amendment of section 17, exemption of amount received for medical treatment on account of death due to COVID. Section 17(2) of the Act has been amended. This is an amendment giving effect to the press statement of the of the Finance Ministry on 25th of June 2021, where it was announced that the income tax shall not be charged on amount received by the taxpayer for the medical treatment from employer or any person for treatment of COVID during financial year 1920 and subsequent years. This is a retrospective amendment. So this would be applicable from assessment year 2021 onwards. So this amendment specifically mentions that any amount received in respect of any illness relating to COVID-19, it is exempt to tax, subject to conditions as the central government may by notification in the official gazette specifying this behalf. So subject to the conditions that is going to be prescribed by the central government by notification of the official gazette, the amount received by the employee in this context is exempt from tax. Treatment with respect to illness of COVID can be a hospital-based treatment, can be home-based treatment, can be Ayurvedic treatment or any other mode of treatment. So we will have to wait and see what is the conditions that the central government prescribes in this regard. But since it's being a retrospective amendment, the benefit of this section could be claimed in applicable scenarios. Then we saw amendment of section 35, where inadvertent error was there in the amendment last year. So that has been rectified. So the error was that under that section 35(1)(a), research association, universities, colleges, they receive donations. So one of the for the donor to claim a deduction, the research association has to file a statement of donation received by them. Inadvertently in the act, it was mentioned that the research association or college or any other association, they would not be allowed the deduction if the statement is not filed. So that was an inadvertent error. That inadvertent error has been rectified, stating that the deduction to the donor will not be applicable, will not be available unless the university or the institution has furnished a statement of receipt of donation. Hello? Hello?
ਪਹਿਲਾਂ ਥੋੜਾ ਜਿਹਾ ਤਾਕਤ ਜੀ ਆ ਰਹੀ ਹੈ ਸਰੀਰ 'ਚ ਥੋੜੀ ਜੀ
Sir, can I continue, sir?
Yes, sir, please.
सेब हो गया केला हो गया
Sir, shall I continue? Any disturbances there?
Harish, please.
Sir, you continue, sir, please.
Okay, sir, fine, sir. Okay, sir. The next we saw the amendment of section 37 with effect from 1st April 2022. With effect from 1st April 2022. Section 37 of the Act provides that where an expenditure, if it is laid out wholly and it allows expenditure that is wholly and exclusively for the purpose of business or profession. Explanation 1 to section 37 provides that if any expenditure incurred by the assessee for any purpose which is an offence or prohibited by law shall be deemed to have been incurred for the purpose of business or profession, and no deduction or allowance shall be made in respect of such expenditure. However, it seems that certain taxpayers are claiming deductions on expenditure incurred in offering certain benefits or perquisite to a person which are not intended to be allowed under the section, like meeting the expenditure related to travel, hospitality, conference, etc. In this case, acceptance of such benefit or perquisite by such person is in violation of law, as the case may be governing the conduct of such person. The explanatory memorandum specifically gave reference to the circular of CPDT of 2012, circular 5 of 2012 dated 1/8/2012. That said circular was shared yesterday for everyone. That circular specifically deals about pharmaceutical industry, pharmaceutical companies, whereby pharma companies, they give free samples to the doctors, and whether that expenditure can be claimed, gifted to the doctors, travel facility to the doctors, because Indian Medical Council guidelines have a restriction stating that doctors at some stages, they cannot receive the free samples, and the Indian Council guidelines are pretty much detailed about all this aspect. So the CPDT gave a circular whereby, in that CPDT circular, there is some case laws were also very mentioned, whereby these pharmaceutical companies, they give some samples to the doctors. This is an example that is, it's not an example, it is the real scenario that happened in a case law. In that explanatory memorandum, that particular case law and this particular situation is mentioned. So according to that particular case law, what had happened is that Indian Medical Council has prohibited doctor concerned from receiving any samples or kits. So what is the scenario in that is that the doctors concerned have received a drug, an advanced specified drug from the pharmaceutical companies, and they have specified and they have prescribed that drugs instead of the generic drugs. So that was one of the discussions aspect in that case laws. So put together the amendment with respect to this, what it points out to that, if there is a guideline by any regulator, for example, Indian Medical Council in this regard. So if the regulator says that the persons who are registered under the regulators, if they are prohibited from accepting any gift, in that case, the company that is making that gift, the company that is giving that facility, that expenditure will not be allowed to that particular company. There are other decisions of the tribunal saying that the Indian Medical Council's guidelines apply only to the doctors concerned. It does not apply to the pharmaceutical companies. There are some decisions on this. The explanatory memorandum clearly acknowledges that these decisions are not the legislative intent of the government. So they want to make it categorically clear, stating that any expenditure incurred by the pharmaceutical company in the nature of gift, travel facility, hospitality, cash or monetary gain, in that case, it will not be allowed as a deduction to the hospital. So this is one of the amendments that was made. Yesterday I also requested all of you to please find time to read this explanatory memorandum, especially for these two amendments, because the detailed reasons are given. Yesterday, due to the time constraints, I could not list out the entire part of the explanatory memorandum, but many case laws have been overruled, and the legislative intent of the government is pretty much clearly spelled out. So these are the decisions that in favor of the assessee and in favor of the department. So what is the amendment in this regard? Amendment has been broadly of three specified natures, I would say. For the removal of doubt, it is hereby clarified that the expression expenditure incurred by an assessee for any purpose which is an offence or prohibited by law under explanation 1 shall include and shall be deemed to have always included the expenditure incurred by the assessee for any purpose which is an offence which is prohibited by any law for the time being in force in India or outside India. So yesterday I remember saying that while certifying the tax audit report, while computing the while making the computation statement or finalizing the audit, we will have to be aware of all the laws that is applicable to the business entity in India, and we should also have knowledge of what all the laws that is applicable to the Indian entity outside India. For example, if they're doing operations outside India, we will have to have knowledge of all the laws, and we will have to see whether any particular expenditure relates to one offence that is prohibited by any law for the time being in force in India or outside India. There can be many practical examples whereby an entity can be having an operation, say in Singapore or Malaysia or in England. There, a particular offence has been created and a compensatory damage is being levied by the court of England, say Malaysia or Singapore. That compensatory damage, it is compensatory in nature. That amount that the entity is going to pay, that also would not be allowed in the hands of the entity. So 37 has been amended to say that any expenditure which is for an offence under an Indian law or a foreign law, if that is incurred, that will not be allowed. The next of the amendment is any expenditure that is incurred to provide any benefit or perquisite in whatever form to a person, whether or not carrying business or exercising a profession, and acceptance of such benefit or perquisite by such person is in violation of any law or rule or regulation of guidance as the case may be for the time being in force governing the conduct of such person. Though the explanatory memorandum refers to the pharmaceutical industry in this regard, the actual amendment will not restrict itself to the pharmaceutical industry. In my view, it will extend to all other industries whereby private sector players, private sector companies, which they are doing some government projects, and in that government projects, not many aspects would be there, intricacies would be there. And if there is any aspect, if there is any payment made by the private sector entity, for example, a private limited company, it is involved in any taking up any government project, any particular expenditure made by the private limited company, if that expenditure is prohibited by any guideline of the government, it can be a regulation or a guideline. For example, National Highways Authority can prescribe a guideline with respect to road contractors. So every regulator will prescribe a guideline as to what is allowed, what is not allowed. government servants are prohibited from accepting gifts during their service. Some government servants after retirement, they are rendering service to the private concerned players. So to that extent, there are restrictions whether it applies over there also. So in short, any expenditure which is made by any business entity for any benefit or perquisite which is in violation of the respective law or rule, not Income Tax Act, but the respective law or rule, if that is prohibited by the respective law or rule, it will be disallowed, irrespective of the fact that the person to whom we are paying, whether that person is carrying out a business or profession. So one another view that can emanate from this is that, yes, there is an expenditure. It is prohibited by the respective rule or regulation. It is getting disallowed in the hands of the entity under 37. Whether the same is taxable in the hands of the recipient because it's disallowed on one side. So since it is disallowed on one side, whether the same is exempt in the hands of the recipient, in my view, no. The recipient also would be liable to tax. So it is a classic case of same income getting taxed twice. The last of the explanations in this, the last limb of the explanation, rather, any expenditure incurred to compound an offense under any law for the time being in force in India or outside India. So any compounding offense, fees paid for compounding an offense in India and amount paid for compounding an offense outside India, that will be disallowed. So section 37 has been amended, very strong amendments, and in my view, we'll have to examine every expenditure and see whether if it is pertains to any of these three limbs, and if any of these three limbs is attracted, then disallowance is warranted for. And the disallowance, sometimes it can be very huge. For example, an offense to, for example, a company commits an offense under FEMA and it is getting the offense compounded under FEMA. For compounding fees, it pays nearly 5 lakhs to 10 lakhs. That 5 lakhs or 10 lakhs paid as a compounding fee will be disallowed under section 37. So that will be having tax impact. Then accordingly, we will have to plan everything and we'll have to have a discussion with the client. In short, this aspect will be having serious implications in the future, and we'll have to be very, very cautious while completing the audits, in my view. The next of the amendment is amendment of section 40, a retrospective amendment of 1st April 2005. So what is this amendment? Again, reference to the explanatory memorandum. The explanatory memorandum goes way up to 1967 for a circular, and it starts the reference from that circular starts, and the intention of the government from 1967. It is being portrayed in the explanatory memorandum. So, in short, what is the government trying to achieve in this regard? Section 40 specifies that any rate or tax shall not be deducted in computing the income. So, what is the definition of the rate or tax? Whether surcharge can be claimed as an expenditure, whether education cess can be claimed as an expenditure, or any cess paid to the central government or to the state government, whether that can be claimed as an expenditure. So this has been a matter of dispute over the years. A Supreme Court judgment, it said that any cess or any tax or surcharge, it is not an allowable expenditure, and there are some contrary judgments to the Supreme Court judgment which says that no, cess can be allowed as an expenditure. The explanatory memorandum analyzes all these judgments that are in favor of the matter, that is against the matter. Then, citing the principles of interpretation and holding that the circular of the CBDT in 1967 and the decision of the Honorable Supreme Court of the Srivastava case, the holding that to be final, this amendment has been made. One of the cases is Sesakova Limited's case, Dambal Fertilizers case. Again, the explanatory memorandum talks very detailed about these two amendments. I would request everyone of you to find time to read this part of explanatory memorandum. That is where the reasons have been given in a very detailed manner. So, what is the amendment that has been made? Explanation 3 has been inserted and shall be deemed to be inserted with effect from 1st April 2005. Retrospective amendment. For the removal of doubt, it is hereby clarified that for the purpose of this clause, the term tax shall include and shall be deemed to have always included any surcharge or cess by whatever name called on such tax. So going forward, any surcharge, any cess, it will be regarded as tax for the purpose of section 40, and it will not be allowed to be claimed as an expenditure. We also saw an example as to what are the types of cesses, that is some of the cess that is applicable presently. There is one cess particularly called as infrastructure cess, that is cess levied by the central government on vehicle mass productions at ranging from 1 to 4%. And there is agriculture, infrastructure and development cess, and there is building and other construction workers welfare cess act. This example that I could give, it is this building and other construction workers welfare cess act applies to companies that is involved in civil construction, and for example, construction of a road. The value of the contract is 300 crores, and the road is getting constructed over 3 to 5 years time. Every year, as a percentage of cost incurred, the company concerned, they will have to pay an amount as a percentage of cost incurred as building and other construction workers welfare cess. So if it is 10 crores cost incurred for that particular financial year, 1% of 10 crores would have to be paid. That is a cess under the Central Act. Like this cess, there are other cess under the state governments too. That is applicable to the business concern. So every cess that is being paid, whether it is a cess of the central government, cess of the state government, from now onwards, rather from with retrospective effect from 2005, it will not be allowed as an expenditure. This will have serious implications, and this would increase the tax of This would increase the tax of the entities. Since this being a retrospective amendment, I remember yesterday telling that ongoing assessment proceedings, the impact of this can be taken into consideration by the assessing officer. For the closed assessments, rectification under 154 is possible subject to the timelines. If the application is well within the timelines, then we can see a rectification petition under 154 categorically disallowing this expense. Then we can also see notices under 147, the revised 147 rather, subject to the timelines again. A notice coming under this regard. Then the notice can also come under section 263 under the revisionary powers of the commissioner, stating that the order passed by the AO is erroneous and prejudicial to the interest of the revenue to the extent that cess has been claimed in this particular year as an expenditure by that particular entity. So this is amendment with respect to section 40. The last of the amendments with respect to section 43B. This amendment, the language used in this amendment, this will have a connection to the amendment of section 68 that we are going to discuss subsequently. So what was amended in section 43B? There explanatory memorandum specifically mentions that there are cases where, especially under explanation 3, 3CA and 3D of the section, that any deduction of a sum being interest payable to a loan or borrowing from a specific financial institution, it should be allowed only if the interest has been actually paid. That is the concept of 43B. Interest paid to any financial institution, NBFC, it shall be allowed on actual payment. But there are certain situations whereby taxpayers are claiming deduction under 43B on the account of conversion of interest payable of an existing loan into a debenture on the ground that such conversion is a constructive discharge of interest liability, and therefore it amounted to actual payments, which has been upheld by several courts. The explanatory memorandum makes it very clear that such interpretation is against the intent of the legislation. So what they are trying to do is they are amending the concerned explanation 3C, 3CA, 3D. What they are amending? The words debenture or any other instrument by which the liability to pay is at a future date. This set of words, it is being added to the explanation 3C, 3CA, 3D. It is added with what it is being added. There is a loan, there is a borrowing. Now it is any debenture or any other instrument by which the liability to pay is deferred to a due date. So in this section, by this amendment, the government tries to make it clear that a loan is a different product, advance is a different product, debenture or any other instrument is a different product. Why I am making this particular interpretation, I would connect it in the subsequent amendment when we are discussing about section 68. So 43B has been amended, stating that if any loan is being converted as a debenture, then to that extent, it will not qualify under 43B because it does not amount to effective payment of the interest. And due to COVID, not many loans would have been restructured, and some would have been restructured as a debenture. So all those cases we will have to re-examine, and we will have to take a call accordingly to the amended provisions of section 43B. This is the recap of the sessions held up to yesterday. Now I'm starting with the amendments for the day. Amendments for the day, amendments related to section 56. 56 to 7B has been amended with effect from 1st April 2023 and will apply from assessment 2023 and 24 onwards. So, explanatory memorandum says that this is an amendment related to IFSC. In order to further incentivize operation from the IFSC, it is proposed to amend 56 to 7B to provide that specified fund shall also include category 1 or category 2 alternative investment fund, which is regulated under the International Financial Services Authority. So I would like to explain the provisions of 56 2B for the benefit of everyone, so that we can have a better understanding of this particular amendment. 56 7B, which was introduced by the Finance Act 2012. It talks about a scenario whereby a company, it is means public is not substantially interested. It receives share application money, or popularly called as share premium, and this is in excess of the fair market value. In that case, an addition will be made under section 56 7B. However, there are two scenarios in which addition will not be made. One of the scenarios was that if that particular investment was received by a company, and that company being a specified company subject to such other conditions. So what is that such company? What is that specified conditions? This is as follows. The provisions of 56 2B does not apply where the consideration for issue of shares is received by a company from class of persons notified by the central government subject to other conditions. So accordingly, the CBDT-wide notification of 2016 notified the persons to be persons defined under 232 subsection 31, being a resident who is making investment in the case of a startup company. And startup company, the meaning of a startup company means the startup company shall be a company in which public is not interested and fulfills the conditions specified in the DAPP's notification. DAPP has issued a host of notifications from February 2016 to February 2019. In fact, DAPP has been rechristened as DPIIT. And in short, 56 7B does not apply in a scenario whereby a company, it's a company in which public is not substantially interested. It receives share premium, and it receives share premium from residents. It will not be taxable under 56 7B, provided that that company is a startup as defined by the DPIIT or DIPP, and it fulfills the conditions prescribed by the DIPP. So 56 7B does not apply in case of startup company subject to conditions prescribed in the DAPP notification, subject to the CBDT notification of 2016. This is one particular exemption with respect to 56 7B. The other exemption with respect to 56 7B was up to the Finance Act 2021. If the amount is received from a venture capital undertaking or venture capital fund, to that extent, it will not be taxable under 56 7B. Now, category 1 or category 2 alternative investment fund, which is regulated under the International Financial Services Authority Act 2019, has been added to the set of existing institutions under the provision. So, amended scenario 56 7B does not apply in cases where it is a private limited company, where it is a company it is not in which public is substantially interested. If it is a company, it's a startup as per the DAPP, DPIIT notifications and CBT notification of 2016. Then the share premium, to that extent it is being received, it is exempt from tax. This was popularly called as the angel tax. And I would like to recall so many decisions came about with respect to angel tax, aspects governing the agent tax. Then finally, the CBDT, acknowledging the difficulties faced by the companies, they gave out a circular stating that it will not be taxed. So this is the one part of 56 7B. The amendment comes to the other part of 56 7B, whereby if it is a company which in which public are not substantially interested, if it receives share premium, then in that case, if it is received from a venture capital fund or a category 1 or category 2 alternative investment fund regulated under the International Financial Services Authority, that is the IFSC, then in that case, provisions of 56 7B does not apply to that said entity. This is the amendment with respect to IFSC under 56 7B. The next are the amendments with respect to 56 7B. This is with respect to the COVID-related relief. Reference to the explanatory memorandum. Section 56 clause 10 of the Act provides that where any person receives in any previous year from any person or persons any sum of money without consideration, the aggregate value of which exceeds 50,000 rupees, The whole or aggregate value of such sum shall be the income of the person receiving such sum. However, certain exceptions have been provided in the clause for transactions specified therein. The Finance Ministry has released a press statement dated 25th June 2021, where it was announced that the income tax shall not be charged on the amount received. Where income tax shall not be charged on the amount received by the taxpayer from the medical treatment for an employer from any persons for treatment of COVID-19 during financial year 20 and subsequent years. It was further announced that in order to provide relief to the family members of taxpayers, such income tax exemption shall be provided to ex gratia payment also received by the family members on account of death of the concerned person due to COVID. Now, to give effect to the press statement, CBDT's press statement, this amendment has taken place. So, what is the amendment? Any sum of money or property other than immovable property received by an individual from any person in respect of any expenditure actually incurred by him on his medical treatment or treatment of any member of his family in respect of illness related to COVID 2019, subject to such conditions as may be notified by the central government in this regard, shall not be regarded as income of such person. This is subject to the conditions that the central government may actually specify. But I would like to draw attention to the definition of family in this regard. I will cover what is the definition of the family subsequently. This is one particular amendment. The next of the amendment is any sum of money or property received by the member of the family of the deceased person. The first is a case where the concerned individual receives the money. The second case is where any sum of money or property received by the member of the family of a deceased person. That member or family can receive the money from the employer of the deceased person, or they can receive the money from any other person. In either case, amount not exceeding 10 lakhs is exempt from tax subject to conditions. What are the conditions? Where the cause of death of such person is illness related to COVID-19 and the payment is received within 12 months from the date of death of such person, subject to such other conditions as the central government may notify in this particular regard. Then, what is the meaning of the term family? The meaning of the term family is meaning specified by Section 10 subsection 5. Family in relation to an individual. Family in relation to an individual means the spouse and children of the individual and the parents, brothers and sisters of the individual, or any of them wholly or mainly dependent on that particular individual. So, if the family members receive any sum of money from the employer or deceased person, amount not exceeding 10 lakhs is exempt from tax subject to it being received within 12 months of date of death of the person, subject to such other conditions the central government may specify. And who are family members? Family members in relation to individual may be the spouse and children of the individual and the parents and brothers and sisters of the individual if they are mainly dependent on the individual. On second examination or subsequent reading of this amendment, these are my couple of views that I want to share it with everyone. There can be scenarios where this compensatory amount can be received even after the period of 12 months. For example, central government has specified amount of 50,000, I believe, for all the persons who are affected by this. Sometimes the central government's compensation amount can be received even after a period of 12 months. In fact, the press release did not mention any time frame in this regard, but the amendment has mentioned a time frame in this regard. This can, at some cases, in my view, give a difficulty because for amounts received after this 12 months period, if that is going to be taxed, then that could add to the hardship of the persons who are already facing hardship related to the COVID. And one another scenario that I wanted to tell is the definition of family. Family means the spouse and children of the individual and the parents and brothers of the individual or any of them who are mainly dependent on that individual. For an example, let us say a person who is not married, unfortunately due to COVID, that person passed away. The parents are there, brothers and sisters, as the case may be, they are there, but they are not dependent on that individual. In that case, if we go according to the strictest interpretation rules of this particular section, in that case, whatever amount that they get as compensation, that would not qualify for exemption if we give a literal interpretation of this particular definition. So, In this regard, as I mentioned earlier, our institute, also the Bombay Chartered Accountants Society, they have made a representation stating that this benefit should be extended to parents, brothers, and sisters who are not dependent on that particular individual, because already due to COVID, people are affected and they have lost their dear ones. And just because of this particular drafting aspect, which restricts the reduction only to parents and brothers who are dependent on that individual, this is quite tough for all these people. So it has been being represented to the government to consider relaxation of this particular amendment, whereby the benefit can be further extended to the parents, brothers, and sisters who are not dependent on the individual. And the request has also been made to extend the timeline, because in this timeline, the amount is exempt, subject to the fact that it is received within 12 months on the date of death of such person. So there are cases where amount can come after this 12 months. So for cases where amount is being received after 12 months, the relaxation of these provisions are being requested. This is the amendment with respect to section 56. The next of the amendment, very, very crucial amendments with respect to section 68. What is the explanatory memorandum saying with respect to amendment of section 68? Section 68 of the Act provides that where any sum is found to be credited in books of an assessee maintained for any previous year, and the assessee offers no explanation about the nature and source thereof of the explanation offered by him is not in the opinion of the assessing officer satisfactory, the sum so credited may be charged to the income tax of the income of the as the income of the assessee for that previous year. The onus of satisfactorily explaining such credits remains on the person in whose books the sum is credited. If such person fails to offer an explanation or the explanation is found not to be satisfactory, then the sum is added to the total income of the person. Certain judicial pronouncements have created doubts about the onus of proof and requirements of the section, particularly in cases where the sum is credited as a loan or borrowing. It is noted that there is a pernicious practice of conversion of unaccounted money by crediting it to the books of assessors to a masquerade of loan or borrowing. Right, Finance Act 2012, it was provided that the nature and source of any sum in the nature of share application money, share capital, share premium, or any other such amount by whatever name called, credited in the books of a closely held company, shall be treated as explained only if the source of fund is also explained in the hands of the shareholder. So, however, in the case of loan or borrowing, the judicial decisions have held that only identity and creditworthiness of the creditor and genuineness of the transaction for explaining the credits in the books of accounts sufficient, and the onus does not extend to explaining the source of funds in the hands of creditors. It is proposed to amend the provisions of section 68 in this regard. I would like to open section 68 for better understanding. Section 68, where any sum is found credited in the books of accounts of an assessee maintained for any previous year, and the assessee offers no explanation about the nature and source thereof, or the explanation offered by him is not, in the opinion of the assessing officer, satisfactory, the sum so credited may be charged to income tax as income of the assessee for that particular previous year. Provided that where the assessee is a company, not being a company in which public are substantially interested, and the sum so credited consists of share application money, share capital, share premium, or any other such amount by whatever name called, any explanation offered by such assessee company shall be deemed to be not satisfactory unless the person being a resident in whose name such credit is recorded in the books of accounts also offers an explanation about the nature and source of that sum, and such explanation in the opinion of the assessing officer is found to be satisfactory. So in other words, section 68 puts on responsibility as to demonstration of source of source. For example, if I am receiving some amount of share application money, share capital, I would have to mention as to from whom I am getting that money. For example, if I am getting the money from Mr. X, I would have to tell that Mr. X has given the money to me, and I will. Mr. X is also required to furnish the source. So the source source of source. So source of source also is practically called as colloquially called as SOS. So source of source also is required to explanation is to be required is to be demonstrated about source of source to prove that to prove to the satisfaction of the assessing officer that this is not a cash credit. This is the scenario up to now. So in short, the scenario up to now is any sum that is found to be credited in the books of the company in the nature of share application money, share capital, share premium.
These are adjusted. Clear?
Sir, can I continue?
Sir, you please continue. Members, please mute your audio. You please continue, sir.
Okay. So the scenario up to now is section 68, where the assessee is a company, not being a company in which public are substantially interested. The sum so credited consists of share application money, share capital, share premium, or any other amount by whatever name called. And the explanation is found is not satisfactory unless the source of source is being explained and the explanation is found to be satisfactory. So this is the existing scenario. What amendment tries to achieve in this? As I read out from the clauses of the explanatory memorandum, all this particular examination process relates to only an amount received as share application money, share capital, share premium. With respect to loan or borrowing, this particular scenario is not applicable, and the courts have come to the rescue of the assessee, stating that where the genuineness and the creditworthiness of the person who is lending the money, if it is demonstrated, then cash credits addition under section 68 is not applicable. For example, 5627B also I can connect with section 68. If there is any addition made under 5627B for the share premium received by the specified company, additions are also considered under section 68. So either 5627B or section 68. So courts have come to the rescue of the assessee, stating that if the creditworthiness of that particular person is being demonstrated, then there is no requirement for addition under section 68. So that means as long as there is a document demonstrating the creditworthiness, it is there, then that is fine. The document being the PAN number of the concerned person, and if the creditworthiness is being demonstrated, then addition under 68 is not required. That is, in other words, that person is not required to explain about the source of source. So this is one particular view that has been followed by the courts in this regard. The explanatory memorandum addresses this, saying that, however, in the case of loan or borrowing, the judicial decisions have held that only identity and creditworthiness of the creditor and genuineness of transaction for explaining the credit in the books of accounts is sufficient, and the onus does not extend to explaining the source of funds in the hands of the creditor. Now, it is proposed to amend the provisions of section 68 of the Act so as to provide that nature and source of any sum, whether in the form of loan or borrowing or any other liability created in the books of an assessee, shall be treated as explained only if the source of funds is also explained in the hands of creditor or any entry provider. However, this additional onus of proof of satisfactory explaining the source would not apply if the creditors is a well-regulated entity like venture capital fund, venture capital company registered with the SEBI. So what is the amendment in this regard? The first proviso has been amended, very, very crucial amendment, provided that where the sum so credited consists of loan or borrowing or any such amount by whatever name called, any explanation offered by such assessee shall be deemed to be not satisfactory unless the person in whose name such credit is recorded in the books of the assessee also offers an explanation about the nature and source of sum so credited, and such explanation, in the opinion of the assessing officer, has been found satisfactory. Though this might seem to be a very one line or simple line, the implication is huge. Why it is huge? The first proviso, as we could see, the first proviso talks about share application money, share capital, share premium, or any other amount by whatever name called. So share application money, share capital, share premium, and amount that can be regarded as an amount in the similar bucket. So proviso 1 talks about that one. So any sum received as share application money, share capital, source of source has to be demonstrated. Such explanation has to be found to be satisfactory. The second proviso, by this words, provided that where the sum so credited consists of loan or borrowing or any such amount. So these words, loan, borrowing, or any such amount, it is so bigger in scope. For example, after the demonetization, not many cooperative societies, in the closure of assessment of cooperative societies, the cooperative societies were being asked to explain about the source of deposits in the cooperative bank societies banks. So that is one particular scenario where it happened. And while explaining the amendment with respect to section 43B, I said that lawmakers by amending section 43B have indirectly conveyed that loan is different product, borrowing is a different product, debenture is a different product. So this amendment of the first proviso provided that where sum so credited consists of loan or borrowing or any such amount. So whether a debenture can be considered as any such amount in this regard, well, we'll have to wait and see for the times to come. But the implication of this is, again, at the cost of repetition, it is very huge. Why it is so huge? Because the share application money can be treated as a loan or any amount of loan that we receive. For example, third party funding, if the company is getting loan from a third party, that third party can be a resident or a non-resident. And even the bank borrowings are falling under the scope of this proviso, because the words used is where the sum so credited consists of loan or borrowing or any such amount. So loan received from banks, other financial institutions, NBFCs, cooperative societies, even sometimes loan received by the government, loan received from the government. Everything comes under this amended proviso, whereby to demonstrate that this is not that addition under section 68 is not required, we will have to demonstrate that this is the person who has given us the loan. In other words, the bank or the financial institution or the cooperative society will have to say that this is the financial institution or bank or cooperative society from whom we have received the loan, and they will have to explain about their source. So that is the effect of this particular amendment. So any sum credited, so credited consists of loan or borrowing or any other such sum by whatever name called, and any explanation offered by such assessee shall be deemed to be not satisfactory unless the person in whose name such credit is recorded in the books of assessee also offers an explanation about the nature and source of such sum so credited, and such explanation in the opinion of the assessing officer aforesaid has been found to be satisfactory. So any borrowings from banks, NBFCs, financial institutions, and any borrowings from other companies, it gets covered under the amended scope of section 68. And this also includes amount received from non-residents, amount received from residents. So practical fallouts that can happen in this regard is not all lenders will be willing to share their documents relating to source of funds. So practical difficulties may be faced by the entities in getting the source of funds from their source. So not many people will be willing to share. That is one particular aspect that is a fallout of this. And we will have to be very careful in while closing the audits, especially with respect to section 68, because as I said, the scope of this proviso is very huge. Any sum so credited consists of loan, borrowing, or any other amount. So the first proviso talks about share capital, share premium, and that is not subject to tax, subject to the conditions specified therein. The second proviso, rather the amended proviso talks about loan, borrowing, or any other amount. So this is so big to even include scenarios where loan borrowed from banks, financial institutions, cooperative societies, third party players, all that. For all those cases, we will have to give explanation under section 68. So one another fallout that can happen in this regard is if the explanation is found not to be satisfactory, what is going to happen? It is going to be an addition under section 68, and there is going to be an tax. The tax for that addition is governed by section 115 BBE. That is a special section whereby tax up to 60% is being levied. Then surcharge is being levied at a particular stage, and a penalty also would be levied at a particular stage. So if anything is getting missed here, the consequences could be very huge, whereby for a particular sum, say of 1 lakh, if it is not being explained to the satisfaction of the officer, then the tax effect of that can come to nearly 90,000 rupees. Such is the impact of this amendment, whereby any borrowing at the cost of repetition, any borrowing that the entity makes, such credit, it is recorded in the books of accounts, and the assay also offers an explanation about the nature and source of such sum so credited. So source now also is extended to all loans and borrowings that a company or an entity receives. It is not restricted to share capital, share application money, or either like regard. It is applicable to everything, and it is also applicable to debentures, because some might have a view that loan or borrowing or any such amount, so debenture is not included in this. Because if we can go by the language used by section 43B, the lawmakers have specifically said that loan is different, borrowing is different, debenture is different. So in my view, if that view is being applied here, that would lead to additions under section 68, because the words used here is now sum so credited consists of loan or borrowing or any other such amount by whatever name called. So debentures also come into this bucket. So all these credits, it has to be satisfactorily explained to the satisfaction of the assessing officer. Otherwise, there is a scope of an addition under section 68, and the tax effect could be nearly 90% of the amount coupled with the penalty proceedings. So while posing the audits or while auditing, you will have to be very, very careful with respect to section 68, and all the documentation and the source of those documentation, everything, it has to be perfectly intact, and it should be in a stage of, it should be in a possible demonstration mode as and when required, so that the additions under 68 can be legally avoided. There are other practical situations also. For example, today the company might receive a loan from a person, or an individual can receive a loan from a person, and the loan can be settled in 1 or 2 years' time. By that time, the assessment kicks in. The relationship between the borrower and the lender is spoiled. Even after the loan being settled, the lender will not be in a situation to share the source details. That is one practical fallout that can happen because of this amendment. And the second practical difficulty that can happen because of this amendment, the lenders will not be willing to lend the amount, because the concerned persons are rather going to ask to please give the source of source for me to ensure that there is no addition under section 68 on because of this. So to that extent, availing of loan to that extent will be difficult for those persons who require loan. So this is a very crucial amendment that we'll have to be very, very careful while finalizing the audits and going forward. The next amendment is amendment of section 69. This is rather, I would say, the Air India amendment, consequent to Air India amendment. Section 79, it facilitates strategic disinvestment of public sector companies. So in Air India scenario, we saw how Tata's acquired the Air India company. Air India had huge losses. Section 79A says that carry forward of loss and set off of loss is allowable, subject to that 51% shareholding is being retained both at the year in which the loss was first carried forward and the year in which the loss is first claimed. Carry forward, set off, and claim. So at these two instances, the 51% shareholding should remain intact. This is the provisions of section 79. Explanatory memorandum says that section 79 of the Act provides for carry forward and set off of loss in state of certain companies. Section 79(1) of the said section inter alia provides that where a change in shareholding has taken place during the previous year, in case of company not being company in which public or substantial interested, no loss incurred in any previous year prior to the previous year shall be carried forward and set off against the income of the previous year, unless, as on last year of the previous year, the shares of the company carrying not less than 51% of the voting power were beneficially held by persons who beneficially held the shares of the company carrying not less than 51% of the voting power on the last day of the years or years in which the loss was incurred. Subsection 2 of the said section provides that certain circumstances in which provisions of section 1 shall not apply. In order to facilitate this strategic disinvestment of public sector companies, it is proposed to amend section 79 of the Act to provide that provisions of section 79(1) of the Act shall not apply to an erstwhile public sector company, being an Air India, for example, in our case, Air India, subject to the condition that the ultimate holding of the erstwhile public sector company immediately after the completion of the strategic disinvestment continues to hold directly or through subsidiaries or subsidiaries at least 51% of the voting power of the erstwhile public sector company in aggregate. It is further proposed to provide that if the above condition is not complied with in any previous year after the completion of strategic disinvestment, The provisions of subsection 1 shall apply for such previous year and subsequent previous year. So what is the definition of the term erstwhile public sector company and strategic disinvestment? So the provisions of section 79 shall not apply to an erstwhile public sector company subject to the condition that the ultimate holding of such company immediately after the completion of strategic investment continues to hold directly or indirectly through its subsidiaries. So what is an erstwhile public sector company? Erstwhile public sector company means a company which was a public sector company in earlier previous years and ceases to be a public sector company by way of strategic disinvestment by the government. So what is a strategic disinvestment? Strategic disinvestment means sale of shareholding by the central government or any state government in a public sector company, which results in reduction of its shareholding to below 51% along with the transfer of control to the buyer. So practical example that I can give in this regard, I can take Air India's example, assuming the numbers, I don't know the real numbers, but assuming that Air India has a loss of 1,000 crores and the Tatas have purchased the Air India. So 51% control, the strategic disinvestment, this provision does not restrict the carried forward loss. So the loss is being 1,000 crores. The next 3 years, for example, Air India makes a profit of 400 crores. To that extent, 400 crores can be offset against the carried forward loss. That is, the shareholding change in the shareholding of Air India will not affect the carry forward of losses of Air India to the extent of 400 crores. However, assuming that that's an example perspective, if 4 years later, if Tata's relinquish their share or sell their shares in Air India to some other company, to that extent there is a change in the 51%, then in that case, the provisions of section 79 commences because of the fact that the 51% shareholding has changed. The 51% of the shareholding should remain in the date of carry forward of the loss and in the date of effectively utilizing that particular loss. So this is the amendment with respect to section 79(1). The next of the amendment is insertion of section 79A, set off of loss in search cases. So reference to the explanatory memorandum. Before that, I would like to give a brief summary of this. What happens generally in search or survey? Search or survey, I'm excluding the TDS survey from this perspective because the section also excludes TDS survey for this particular purpose. So there is a search and survey, and in that search and survey, documents are found and the addition is being made by the assessing officer as a consequence of the search or survey. Let's assume that addition is, for example, to the extent of 1 or 2 crores. There is already accumulated loss of the, we assume that there is an accumulated loss of the entity to the extent of 3 crores. So what would generally happen is that they would make an addition of 2 crores. The assessee concerned would offset this 2 crores addition with the brought forward loss or the accumulated depreciation loss. So that has been happening in certain scenarios as the lawmakers mentioned in the explanatory memorandum. So in this background, let us have reference to the explanatory memorandum. Chapter 6 of the Act deals with aggregation of income and set off or carry forward of loss. In section 70 to 80 of the Act, there are specific provisions relating to set off or carry forward and set off of losses while computing the income under various sets and with respect to different classes of persons. It is noted that in some cases, assessees claim set off of losses or unobserved depreciation against undisclosed income corresponding to difference in stock or undervaluation of stock or unaccounted cash payment, etc., which is detected during the course of certain survey. Currently, there is no provision in the Act to disallow such set off, or no distinction is made between undisclosed income which was detected and owing to certain seizure or survey or requisition proceedings and income assessed in scrutiny assessment in the regular course of assessment. Though for incomes falling under section 68, section 69, 69B, the specified restriction is that the restrictions in section 68 and the tax impact arising out of 68 we discussed a few moments ago, allowing the adjustment of undisclosed income detected as a result of such a requisition or survey against a loss or unobserved depreciation is resulting in short levy of tax. The provision of non-adjustment of loss or unobserved depreciation against this undisclosed income detected as a result of such a requisition or survey would help in ensuring that proper tax is paid on the income detected due to a search or survey and also result in increased deterrence against tax evasion. Therefore, an amendment is proposed to address the above situation. What is the amendment? Notwithstanding anything contained in the Act, where consequent to a search under 132 or a requisition under 132A or a survey under 133A, other than survey under subsection 2A. Other than that subsection 2A survey is the TDS survey. So if it has to be a search, it has to be a requisition under 132A, it has to be a survey under 133A other than TDS survey. Notwithstanding anything contained in this act, where consequent to a search under 132 or a requisition under 132A or a survey under 133A other than TDS related survey, the total income of any previous year of an assessee includes any undisclosed income. No set off against such undisclosed income of any loss, whether brought forward or otherwise, or unabsorbed depreciation under section 32 shall be allowed to the assessee under any provisions of the act in computing the total income for the previous year. So in simple words, if there is an undisclosed income that is being found out, that can be either due to related to stock, difference in the valuation of stock, or any other undisclosed income. If there is any undisclosed income as a result of the search or survey, then in that case, the brought forward depreciation, the brought forward loss, no carry forward of loss, no current loss, there is no reduction for brought forward depreciation if there is an undisclosed income as a resultant of this particular search. So the section also explains the meaning of the word undisclosed income for this purpose. For the purpose of this section, the expression undisclosed income means any income of the previous year represented either wholly or partly by any money, bullion, jewelry, or other valuable article or thing, or any entry in the books of accounts, or other documents or transaction found in the course of a search under 132, or a requisition under section 132A, or a survey under section 133A, other than 2A. 2A means the previous survey, which has not been recorded on or before the date of search or requisition or survey, as the case may be in the books of accounts, or any documents maintained in the normal course during the previous year, or the same has not been disclosed to the principal chief commissioner or chief commissioner or principal commissioner or commissioner before the date of search or requisition, as the case may be. So it has to be an income that can be either in the form of money, bullion, jewelry, or either a valuable article or thing, or any entry in the books of accounts, or any documents or transactions found in course of the search, which has not been recorded in the books of accounts before the date of search or acquisition. For example, search happens tomorrow. If it is not recorded up to tomorrow, it has not been recorded at all, then that fits in the definition of undisclosed income. Or if that particular undisclosed income, it has not been disclosed to the principal chief commissioner or commissioner or principal commissioner or commissioner before the date of search or requisition or survey, as the case may be. So this particular limb talks about a scenario whereby there is a particular assessee, there is an undisclosed income, that income is not disclosed in any of the previous years. Then prior to the date of search, that information is being disclosed by that particular assessee to the principal chief commissioner or principal commissioner or commissioner before the date of search or requisition, as the case may be. So if that has not been disclosed, then it would form part of the word undisclosed income. Then undisclosed income also includes any income of the previous year represented either wholly or partly by any entry in respect of an expense recorded in the books of account, or other documents maintained in the normal course related to the previous year, which is found to be false and which would not have been found to be so had the search not been initiated, or the survey not been conducted, or the requisition not been made. That means, as a result of search or survey that has been found out, if the search or survey had not taken place, that would not have been found out, and to that extent there will be loss of revenue to the government. So income of that nature, that also forms part of undisclosed income for the purpose of this particular section 79A, and accordingly carry forward of current loss, carry forward or brought forward and setting off of the current loss, carry forward and setting of the depreciation loss, to that extent will stands restricted because of this amendment of section 79A. So I finished presenting the content for the day. The floor is open to questions.
Thank you, Vivek Rajan sir.
Thank you, sir.
Members, it is open for the questions. or you can put it in chat box also. Floor is open for the queries. In fact, you can compile all the queries from the day one, first session to fifth session. Any queries you can now ask or chat, or you can send a mail also, because this is the final session of this series. Of course, we have second 2.0 session series is there with respect to this amendments. Probably, as we have already informed before starting the session, probably in the fag end of April or first week of May. So members, you can send a mail also, so that it will be answered in future. Okay. Hope they will compile it and send a mail, sir.
Okay, sir.
So now, vote of thanks on behalf of Direct Tax Committee of Chengalpattu branch of SARC of ICAI. I thank CA Vekrajan for his excellent presentation right from first session to fifth session continuously. In fact, the flow which we really, sir, we really appreciate, and in fact we have a we really, in fact, had it been a physical meeting, definitely you would have got an applause, sir. Thank you.
Thank you.
So
Thank you,
we really, it is very informative and in-depth, and you have made a deep dive into all the amendments. In fact, as you said, you have covered part of it. There are a lot more amendments need to come. Thank you, sir. Thanks for your excellent presentation.
Thank you, sir.
And we expect the same flow of the amendments in the second series also. And I also thank the MC team for arranging this session, and also all the members for their patient listening. Thank you, sir.
Thank you, sir. Thank you to each and everyone, entire study circle, MC team, MJB sir, Satya sir, Raghavan sir, and everyone. Thanks to every member who participated this, and thanks for the patient listening. Thanks to everyone for the opportunity. And as I said, if you have any questions or suggestions, please do let me know. And your valuable feedback is of tremendous use, because the quality of the content can be enhanced and questions also can be addressed, because I believe that the more we share and more we get the feedback, to that extent the quality will improve, and it's benefit for not only for myself but for everyone. So thank you to everybody for this opportunity. Thank you. Good day.
Yeah, members, once again I am reminding, as I have informed in the beginning of the session also, the CBDT is going to notify the forms 3CA, 3CB, 3CD. Now our Direct Tax Committee of ICAI has requested all the members to give their feedback and suggestions and amendments in the new form, which is going to be notified. So for which our Chengalpattu branch has already circulated a Google form, wherein you can give your valuable feedbacks and inputs, and as well as the amendments, whatever you propose. Because when we fill up the form only, we'll come to know this, why this is being asked, and why we have to give this. And it is some provisions are redundant and some provisions are not required to be given. So that kind of amendments or this inputs you can give, so that all these valuable inputs will be consolidated and it will be forwarded to our Direct Tax Committee of ICAI. So in turn, it will be forwarded to CBDT before they notify. So for which the time frame is 14th of March. Kindly share your views so that it can be delivered to Direct Tax Committee on or before 15th of March. So kindly give your views, sir. Thank you. Thank you, everyone. Thank you, members. Thank you, speaker.
Thank you, sir. Thank you. Thank you.
Thank you, Rajan. Thank you.
Thank you, sir. Thank you, sir.
Thank you. Thank you. என் செஷன் கொடுத்துருமா.
Sir, hello.
Yes, ma'am.
Sir, end close பண்ணிடவா sir?
End கொடுத்துடலாம் please.
Thank you.